Hello, and welcome to the Navigating the Minefield of Crypto Adoption. I am the moderator of this panel. My name is Susan Joseph. I'm an attorney and a consultant. Let me just take a minute and say, not your attorney. Always have to do that disclaimer. All views are my own, and I'm sure each panelist will make the same disclaimer. My background is both in crypto issues, securities, data usage, tokens, open source, all those kinds of things. I'm currently working on digitization initiatives, some fintech initiatives, ESG initiatives, and I also just received funding for a startup that I have regarding data and blockchain, funding from the NSF. And finally, I run a not-for-profit called Diversity in Blockchain, which focuses on inclusion and networking for this space. I'm really thrilled to have this panel to moderate a bunch of world-renowned experts literally scattered across the globe. So let's just get started with that right away. I will give you a brief background, couple of minutes of what we're going to discuss, and then we will dive right into the panelists. So crypto is a virtual asset. I'm doing a bit of a level set, not knowing where everybody is coming from, and I don't want to get sort of bogged down in any sort of jargon here because we want everybody to get some takeaway from this, and it can get jargony very fast. So crypto is a virtual asset, and it's built on the premise that there should be a bigger pie, one that a lot of people can access. It is backed by an open internet, and the vision is a transfer of value on the internet, crypto being the native mechanism, the digital mechanism to transfer this value. It is decentralized, so not only any one person or institution can control it, and often referred to as unstoppable. I would say takeaway would be that it is not going away. It touches on many areas, which is why we're all here, both traditional and emerging. And many regulators think it comes within their purview, which is something that everybody needs to be aware of and respect. It's alternatively, of course, being crypto, described as a backbone for a new financial structure, a scam, speculation, an enabling mechanism for financial inclusion, surveillance technology because you can see the transactions, think Colonial Pipeline. And it is something that is high risk, high reward because it is new. So knowing your risk appetite is pretty important when you're dealing with this, which should directly impact part of this conversation. It has vast implications. You need only look at what happened when Facebook decided that it wanted to issue a stable coin and how the world's governments decided to become extremely vocal in the conversation and then move towards central bank digital currencies, which are not the same thing as crypto, but the conversation is definitely sparked and definitely ongoing. And you can see the latest evidence of that with El Salvador declaring Bitcoin its official currency. So one thing it is not is boring. And one thing that it is extremely active, that it happens every day. So with that, I want to get to the panel, and I would ask each of you to give a brief introduction and tell us how you got involved in this. Because as we know, there is no, quote, crypto university. Everybody became involved because they had a certain interest. And it's really useful and I think interesting to understand how everybody came involved. So I'm going to go in order of how I see you on my Zoom panel. So Tone, you're first.
Sure. Hi, everyone. My name is Tone Vays. I come from the traditional Wall Street environment, where I was a risk analyst at Bear Stearns, ironically, before the financial crisis. After that was at JP Morgan Chase, a couple of other companies. Heard about Bitcoin as far back as 2011 when I started following the Ron Paul campaign for president and listening to alternative media that actually was covering Bitcoin back then in 2011. It wasn't enough for me to really think about it much, but in 2013, when I was watching and witnessing the banking confiscation of the Cyprus banks, that got me very interested in Bitcoin and its amazing and unique quality of unconfiscatability. I felt that Bitcoin was actually the only asset that is unconfiscatable. I know there's recent articles this week that show otherwise, but that's not exactly true. Just a lot of misunderstanding there. And since then, I just started educating about Bitcoin and crypto. Today, I have a YouTube channel under my name, Tone Vays. I organize several conferences focused on education. One is called Understanding Bitcoin. One is called Unconfiscatable, and another one more related to finance. My expertise is also in trading as well. So lots of stuff on my YouTube channel involve trading. That's pretty much it on my background. And I'm sure we'll move on with the panel after for some thoughts.
Thank you. Okay, Nisa, you're up.
Hi, everybody. I'm Nisa Amoils. I have been in venture capital for the past 11 years. I started out also as a securities and corporate lawyer, and in between worked at what is now IAC, Interactive Corp, investing in the early stages of the internet. We were invested in a company called Seed Invest, which was sold to Circle early on, and involved in the crowdfunding act or the Jobs Act. And so that led down to cryptocurrencies, got involved pretty early, and have basically been investing in that sector ever since. And I'm looking forward to the panel. Thank you.
Thanks, Nisa. Okay, Arun, you're next.
Good afternoon, everybody. Arun Ghosh. I lead KPMG's blockchain and crypto business. So I come at it from a very different angle in terms of, what does it mean for our clients? What does it mean for our sectors? I got started in crypto and blockchain about 2017 when the world blew up, right, in more ways than one. And we started looking at the technology itself when Web3 and its fundamentals became clear that Bitcoin was the number one use case. And we had to pay attention to it because a lot of conversation around asset classes and regulatory reform, which is a lot of work that we do in terms of security controls, was beginning to take shape. That's how we got into it. Today we have a pretty significant amount of work going on in the space. Happy to share some stories. I have to spend more time here.
Thanks, Arun. Okay, Noah, last but definitely not least, and let people know where you're talking from, because I think it's important to know that this is global.
Yes. Hi, my name is Noah, dialing in from Uganda in East Africa. My background is in cybersecurity, about 16 years in cybersecurity. And it's through that I got access or heard about Bitcoin quite early, I think back in 2012. As part of my work, I do a lot of cybersecurity consulting for corporates and for businesses and for governments. And I came across it because it was inevitable. And got interested. We and some business partners of mine founded a company that eventually became Savannah, where I currently serve. We got serious mainly when we started building out our own exchange back in 2016 because of the frustration of trying to get access to crypto in Uganda. We had to change Uganda shillings to dollars, then dollars to crypto, and that was very expensive. So we built our own fiat to crypto exchange back in 2016. Still very niche market at the time. And we then, took it upon ourselves to educate anyone who was willing to listen about crypto and blockchain. And so that led us into, organizing Africa's largest blockchain conference back in 2018, the Africa Blockchain Conference. We did it 2 years in a row, 2018, 2019, creating quite a buzz and putting literally Uganda on the map when it comes to blockchain adoption and having the conversations around crypto in Africa. Since I currently participate in a number of fora, most relevant to the conversations right now. I currently sit as the chair of the National Information Security Advisory Group. This is the pinnacle organization in the country that looks out for our critical infrastructure cybersecurity. Apart from that, my day job is with Savannah, which is a blockchain company, and we build solutions. We build products around blockchain in the areas of identity. We have some interesting DeFi projects, supply chain projects, tokenization. We're looking into interesting things like fractional ownership of real estate. Yeah, we are discussing those things in Uganda. And so I'm excited to be here, excited to share our story on how crypto adoption is evolving in Africa. And yes, it's a truly global trend, to hear some of the similar stories that are being shared across the world. And I'm excited to be here. Thank you.
Thank you, Noah. So I just, as moderator, when I hear an acronym, I'm going to call it out so the audience is familiar. So you use the term DeFi, that is known as decentralized finance, and it is the rails upon which any of the new protocols, the open source protocols, are being built for financial products. If anybody else would like to add to that definition, feel free to jump in, but I just want to make sure that no issues with using it. I just want to make sure that the audience understands, because this space can get very acronym heavy very quickly. So Noah, I'm going to start with you, but then I'll go through, and I want to know why anyone should be interested in investing in space. Because we all know that there are challenges, which we'll discuss later, but what's the opportunities?
So from where I sit or where I stand, traditional finance has, for the longest period, served the middle class, which is a really small percentage in a country like Uganda. Just to give you quick, statistics about Uganda. Uganda is by no means the copy and paste for the rest of Africa, but it's unique. It's similar in a number of ways. We're a population of about 42 million, half of whom are under 15. So we're literally the youngest country in the world. We have a middle class of literally about 1.7 million people. And so a financial system that serves 1.7 million people out of 42 million is way biased. And so we've seen from particular trends like, the explosion of mobile money, which, really sidestepped the traditional banking system and allowed for peer-to-peer transfer in some sort of way. We believe that at least crypto presents a unique opportunity of the evolution of mobile money. So here in Uganda, mobile money is by far the largest enabler for financial inclusion. We have about 23 million mobile money accounts, but it's built on the telecom infrastructure. And as of a recent law, the mobile money business must be separated from the telecoms that really run these businesses for the better part of a decade. And so now they're going to be the payment platform, and they're sort of being squeezed into a traditional finance system, and then they're going to create the problem that it was invented to solve. And so from the onset, we believe crypto is a way in which we can allow participation from the ordinary grassroots, person into an economy that rewards them. Crypto by its very nature, and I'm speaking about, the top cryptos, I'm not going into the exotic ones, but things like Bitcoin that appreciate in value over time, despite its volatility, is a better store of value than the Uganda shilling that depreciates at the rate of inflation. And so someone in a village who's trying to save a few shillings is still experiencing depreciation, and the banking system is not rewarding them, because one, they are not banks, and even if they are, they're being given interest rates that are, that are laughable if you compare to inflation. So we're just creating a systemic problem. So the opportunity in crypto allows us to access a fairer, crypto has its inequalities, yes, but it allows us to access a fairer economic system that rewards every participant with at least the assurance that over a period of time, a long period of time, your asset will appreciate, and I'm thinking about, again, like the likes of Bitcoin. That in its offset is one of the first use cases, because I know in many other places in the world, peer-to-peer payments is a new thing. In Uganda, it's not too new. We've had mobile money for some time, and we have the experience of peer-to-peer, even though it's done in a sort of placebo way through a traditional financial system. But that's the most primary use case that I see, ability to bring more people into the economy and reward them fairly with a means of transfer or a means of value transfer that doesn't depreciate over time, it doesn't devalue over time. And then, of course, now if you add in the lending and the borrowing markets that are autonomous, lower interest rates, that just allows the bottom of the pyramid to benefit from even the microeconomic savings that they make. Don't want to hold too much time, but
that's great.
The worldview from my standpoint.
Okay, perfect. Tone, can you give me your viewpoint? Why should anybody be interested in investing in this?
Well, a lot of people are very interested in investing in this, and it goes back to what Noah just said, an expectation that an asset will go up in value. And that could be very, very dangerous. If the main reason why you are investing in it is for an expectation of profit, these things tend to end badly. And this is how we have so many basically Ponzi schemes all over the crypto space. But before I continue, I just want to back up a little bit on definitions. We talked about the DeFi definition, and you're right, DeFi is short for decentralized finance. But the problem is that I don't see any decentralized finance in the crypto space at all, other than Bitcoin. I can define the metrics as to why Bitcoin is decentralized because I contribute personally to this decentralization by running something called a full node. So I know I am one of the people that is able to help decentralize Bitcoin. I don't see this happening in almost any other project. And while there are these claims everywhere that their project is decentralized, claiming that your project is decentralized doesn't actually make it so. And this is one of my bigger challenges in the space, is to educate people, to ask them the right questions, and not believing in claims that certain projects are decentralized when in fact they're not. And a lot of these blockchain projects, they take on all of the liabilities and the bad stuff that's associated with a blockchain. Most things don't need to be immutable. Most things don't need to be censorship resistant. But if you create the blockchain the wrong way, you still suffer from all the centralized problems of the traditional space, while at the same time taking on all of the inefficiencies of an actual blockchain like Bitcoin. And people have to be very, very careful in actually investing money in the space. It's one thing to use the products if they find them useful. And even the use of these products could potentially be dangerous in a way that when you're using a decentralized system for something necessary for your business, you have to realize that a decentralized system has nobody in charge and no one is responsible for it. So as a business, building something critical on top of a decentralized platform, with that decentralized platform not functioning going forward, you are now going to be the person responsible. You can't just blame that responsibility onto someone else. And now, I personally trust Bitcoin and only Bitcoin as a decentralized platform the way I trust the internet, that it's not going to go down on me tomorrow or in a year or in 5 years. But this is one of the reasons why I'm very, very hesitant into using any other project in the crypto space. But there is lots of speculation there because since the creation of Bitcoin, anyone has been able to monetize a line of code. And people are basically investing in the monetization of a line of code and not spending enough time actually doing the research as to whether that code deserves to be monetized or not. So I'll leave it here for the other panelists, but I'm happy to provide more views on that, or we can get into some specific cases.
Okay, so Arun, I want to go to you regarding sort of the risks here, the pitfalls. And then Nisa, I'm going to come to you about the risks and pitfalls and opportunities in investing, sort of in a more VC type role.
So I'm going to answer that by pivoting a little bit or coming at it from a different angle. This is still early. We're all very early in all of this, right? The way we see the evolution of what we've learned. And from a risk angle and what Tone was saying, I think for the average consumer, there's three things that are important, right? In my brain, I only think of 3s and 5s. That's how much I can process. So three things that I can sort of enumerate is, one is access, right? So if you can provide the level of access to the average consumer investor or transaction professional, we want to call them that, then that bridges the gap. Because even 5 years ago, if you ask somebody, hey, do you know where to buy Bitcoin? You'd get a blank stare. Today, that whole conversation has shifted. can get on any exchange. There's prevalence of household names. I can't take many because we serve them. And so that's point number one. Point number two is your point about risk and regulation. You mentioned, Tone mentioned DeFi, you mentioned DeFi. If you look at the FATF guideline that came out, right, significant progress. It's not that regulators are sitting idly by. They're actually making significant progress, watching the world of DeFi and NFTs explode and saying, hold on a minute, how do we now bring traditional KYC and AML processes to this ecosystem? So the fact that regulators are moving so quickly is very reassuring from where we sit and what we're seeing, right? Which is essentially investor confidence. Okay, that comes back to that. And the third point I will make is, Tone mentioned Bitcoin again as sort of the OG instrument. Absolutely, we still haven't seen a 51% attack, and we won't for a while, right? Because it was built that way. And for the audience that doesn't quite follow the 51%, it's essentially taking over, these hobby projects, as Tone would call it. I'm speaking for you, Tone, if I may, just sort of drawing on your example there. And that's the problem, right? There's a lot of these quick startup sort of windows and saying, we're the next big thing. Okay, then prove it. And then, we come from it from proving, but also the valuation perspective. How much is it worth and where is it going? And this is very interesting from, I said I'm going to pivot, is the NFT conversation. Everybody and anybody wants to be an NFT today. Well, what's the value? Susan, if you...
Can I stop you for a sec?
Yeah.
Can you define first, just give a one line of what FATF is, and then a one line of what an NFT is?
Financial Actions Task Force, that's the FATF, right? And the NFT is a non-fungible token. Basically, once you create it, it's unique. And that's sort of the quick definitions. And most if people listening, the NFT example of choice, everybody's favorite is the Beeple artwork that sold for $69 million. It's all over Google. It's all over Twitter. And then now we have sports teams and everybody talking about all this. But anyway, that's essentially the three things. I set up three things. I want to be cognizant of time, and I want to sort of hear Nisa.
Okay, Nisa, you're up. So what are the opportunities and the challenges in the investing space? So you're investing in companies. What are some points that you would like to make on this?
I agree that speculation has led to a lot of innovation in the past. If you look at where we were at the internet in the early 90s or late 90s, early 2000s, there was a bubble, there was a lot of speculation, and people invested in companies that went under. Some of them also became FANG, right? Facebook, Amazon, Google, etc. And so I think that the biggest risk is not having a lawyer on your team as an investor. So for me, I started out, as you know, as a securities regulatory lawyer, and so have never invested in anything that's become illegal, have this risk management approach. What we've seen crypto doing in the last month, there are a lot of funds that just went under. And I don't think that that's well publicized, but, simply investing in these speculation and trading and tokens without any kind of idea of risk is going to lead to that result. At A100X, we invest in blockchain-based projects that are not necessarily all about crypto or DeFi, but they're also about using the technology for other areas that have been mentioned by the other panelists. That might be healthcare, it might be climate change, it might be supply chains, and it might be legal, title, and identity. And these areas we feel are overlooked, while all the funds are clamoring to get into overpriced rounds. There are entrepreneurs building in these areas and they're undervalued because they don't have anywhere to go if they're not issuing a token, for instance, at the moment. If they go to a traditional ESG or impact fund, those funds are not going to understand the technology well enough to deploy. The people that understand the technology, of course, are not deploying there. So I think that what hopefully we will be reading about in 2 years' time are the companies that we're funding that we feel will be the next wave pre-hype. And that we're doing it with a real eye towards risk, involved in a lot of different regulatory groups and legal groups. And I'm on the board of the DCA. I forgot to mention, thanks for hosting this event, great event. And I'll leave it there for the other panelists.
Okay.
Can I just add
Go ahead.
something real quick? So I just want to add something to what Nisa said and what Arun said. So Nisa, you're talking about companies, but at the same time, all of these companies in the crypto space are issuing tokens. And this is where I also ran a law show on my YouTube channel for a while. And that was one of the issues that myself had from the beginning. I always stayed away from Ethereum from day one. The moment I heard about Ethereum and the first ICO was the Ethereum token, because to me, Ethereum token was a violation of security laws. It looks like the SEC has disagreed, and they're running into a big problem in the Ripple case as to why the SEC did not see Ethereum as a security, when a lot of us, myself included, were doing videos in 2015 explaining how Ethereum is a violation of security laws. And this is the big dilemma that I have, because I do understand the underlying technology and how it works, and most of it don't need an underlying token. And the only reason why that underlying token exists is for speculation and for funding, because they don't want to deal with VCs. And VCs serve a very good function, including eliminating the CEO when they don't perform like they're supposed to. But when you issue a token, you have absolutely no oversight whatsoever. But the biggest challenge to the financial inclusion is what Arun mentioned, is that it's the KYC AML laws, which I think are a travesty on the human race, is the AML KYC regulation, which should not exist, because your money should be your property like you're thinking. And no one should tell you where you can and can't put your money. I feel that regulators are needed to make sure that my money is safe with the person I put my money in, whichever project or investment. But the regulation seems to focus on me and my money and where it came from, versus where my money is going and what's going to be done with my money. So the reason why all of these crypto projects are exploding in speculation is because they ignore the concept of money laundering. So if the regulators actually wanted to do a good job in the crypto space, they should scale back on the money laundering laws and increase their oversight of where these people's money is going. But they seem to be doing completely the opposite.
No, it's lovely. I like it. I wish I could be as provocative as Tone, but I can't. But as I speak in this office, so it's good to be back at work, by the way. So I completely agree. But there's also now the abundance of investigation tools, right? We work with several, right? And there was just this massive announcement yesterday on the Colonial story. Won't go into the details. But to your point, I think the regulators, and I don't want to speak for them, we work with a lot of them, are recognizing that, Tone. I think your point is I'm in violent agreement. Okay, let me just say that. But when we start to follow the money, what we're also enabled with is a significant amount of partner ecosystem. So Nisa, you're talking about investments. I'm going to name a few, from CipherTrace to TRM Labs. We're seeing significant innovation in the de-risking of follow the money, but also the ability to monitor transactions. And Tone, to your point, yes, the laws are yet to catch up, but the private sector isn't waiting. The innovation isn't waiting, right? And so whether it's a DeFi protocol or a decentralized exchange enabling transactions, the follow the money capability exists and is here. That's my 2 cents.
Okay, one point, define a decentralized exchange, and then Noah, let's jump in with your opinion.
Oh, boy.
I'm sorry. I never know. So I want to make sure that people understand what people are talking about.
So very simply, I'll just be a very dumbed down answer. You have the equity markets, the stock markets, which, are controlled by central bodies. A decentralized exchange is essentially where, it's an automated market maker. It's essentially, there is no central authority governing, policing, controlling transactions, right? That's the basic difference between the equity market and the decentralized market. And give examples if people are listening and want to Google. Uniswap is one great example. So I'll stop there.
Okay.
I can debate that a little bit, but I'm not going to.
Can we hear from Noah first regarding Noah, would you like to make some comments? You're on mute.
Sorry. So I come from a different side of that equation. So in the US and Canada and in many parts of the developed world, there is this robust financial infrastructure that's been there for eons. And I come from a place where, again, sorry to sound redundant, the mobile money just disrupted the traditional finance, okay? And so people went from, from a place where we have roughly about 6 million bank accounts, and we have 25 million mobile money accounts. And these transact roughly peer-to-peer. And so again, and this is not unique, it's also following a trend. If I may divert slightly away from crypto and finance, if you look at our telecommunication evolution, and so we came from literally nothing. We had 80,000 landlines in the whole of Uganda. And then we exploded into mobile technology, leapfrogging the fixed line infrastructure and going straight to mobile. And that has exploded. And so now, every Ugandan, because we now have maybe about a similar number of mobile lines, 25 million. Remember that with a population of 42 million, half of them are under 15. So you'd argue that every adult has a mobile line. And so that is meeting, it's about meeting needs, which is where I wanted to address, some of what the other panelists have mentioned about the fluff vis-a-vis what people are saying their projects do and what the projects are actually delivering. My company is part of a project where we're using blockchain to secure digital identity, and we're seeing tangible impact whereby because of the way identity is issued, again, because mobile money is very popular, it's also one of the biggest areas where there is a lot of risk in terms of fraud, because now money is being transacted via SMS. And anyone who knows simply how SMS works, you'll know that that's not a technology to rely on to transfer money. But that's what we had, and it blew up and it became big. So now what we are trying to say is that identity, especially in the sensitive part of, and to address the KYC issue, the area of trying to identify the person who is using a particular line to transact. And so by law, every device, every access to a telecommunication network must be registered with a government issued ID. But then we had, again, another unique thing about Uganda. We have a refugee population of about 1.5 million, one of the largest hosts of refugees in the world. And then there's this whole group of people that don't have access to that. They don't have access to financial tools. They don't have access to digital tools or even to the internet because they don't have any government issued identity. And so by being able to digitize the process of identity attestation, or being able to match identity to a phone line or phone number securely so that you don't have a SIM card fraud, is something that we are seeing blockchain lends itself very, very well. And Uganda is going to be soon one of the first countries to be able to do SIM card registration on a blockchain, at least in Africa. I don't know about the rest of the world. So when we talk of tangible use cases, that's the first example I have, and what it's. I know we're talking about the underlying technology of what crypto is, but again, it's about the use case. Of course, I also, part of our business runs an exchange, and we've seen a lot of interest, and it's largely because of people that are curious. We had that wave of curiosity. I think that plateaued. And now we still have, even in a downturn, from where I sit, we still monitor. We still have people, participating in active projects. We bump into people on the street and they're talking about DeFi. And this is in Uganda on the streets. So talking about DeFi, they're talking about this project, locking funds in this contract. And so, yes, there is the risk, as has been, well explained here. And again, as Arun mentioned, we're very early. We're comparing a crawling baby to someone who has grandchildren. And so what that means, but that this crawling baby is growing pretty fast. And if the internet is anything to go by, the early adopters, some actually make it to become massive successes. And Nisa talked about them. What I see from where I stand is that representing a continent that has been left out on literally every industrial revolution, I'm seeing an opportunity for us to participate, not only as users, but as creators in this new economy that's been created, so that Africans can stop being consumers and start being creators of value. And we now have an equalizing technology that allows us to do that without the heavy baggage of incumbent systems, of legacy systems that we have to comply. We have to make the pegs fit. And so we try to shave off the innovative peg to fit in the old hole. But we in Africa don't have that. And so once we sort that regulation issue, and we are going to solve it, I think we'll move faster than the likes of the US that has hundreds of laws that it needs to comply with and to align with before anyone invests in crypto. I mean, here someone has a mobile money account, they can invest less than $1 in Bitcoin, and they're happy. No need to be a qualified investor. And so some of these hurdles don't exist in our side of the world. It may be a good thing or a bad thing, I don't know. It's too early to tell. But what we're seeing is that we have an opportunity as a continent and as a people to start participating actively in a system that has left us behind for the last, from as far in history as we can see. That's my 2 cents.
Nisa, do you want to jump in? If not, I can also frame this. So because the title of the panel is Navigating the Minefield of Crypto Adoption, and I know that there are a lot of institutional investors who have tuned into this. I can ask the question. So I come to you, I'm in an institution, and I want to invest, but my CFO says no. So what kind of practices and protections should I look at for either investing in small companies, protocols, investing, getting exposure to this market? What can I do? What should I be looking at? And what are my risks? And I can go through sort of a quick laundry list of types of risks, and then you can pick and choose whichever ones you want to address. So you have your typical risks that we already know exist. We have definitely talked about KYC, AML, compliance, tax, audit, cybersecurity, analytics, ESG. Those are your typical risks. But when you have additional risks, such as new protocols, which may fail, rug pulls, scams, hacks, malicious or malfunctioning code, arbitrage opportunities, smart contracts audits, lack of insurance in this crypto space, what the third-party data providers are providing that get locked into these automated contracts, decentralized exchanges, and most interesting, I think, is 24/7 access to market and funds. So there's kind of a laundry list of topics that I think that could be addressed. Or if you want your own topic, then go ahead with it. But let's proceed. So Nisa, you get first crack.
Yeah, I mean, that's a great list. And that's why we stay away from a lot of those areas, because we know that it's one thing to invest your own money and do well. And, we have done that. But it's another thing to put institutional money at that kind of a risk. And what I'm seeing happening is a lot of CFOs or others in these institutions just kind of throwing money at these funds that don't have any kind of risk management and can't necessarily answer a lot of those questions about risks. I mean, So, I mean, we do extensive diligence. We have a very technical team. My partners, one was 15 years as a technologist at Goldman Sachs, the other's 20 years at IBM. We have really deep dives onto actual, if we're looking at a protocol or if we're looking at something that might be at risk of a cybersecurity attack. That's a really passion area of my partners, is identity and security and authentication. And so I would say, regulatory risk has been the one that's been talked about the most at this conference, on this panel. With good reason. There's a lot of different organizations that have their hands in this. And as Tone pointed out, they are mostly regulating by enforcement. The SEC, like every 2 months or so, will come up with another action. And, there's been kind of this non-legislation happening where we just need clarity. We need the equivalent of a token taxonomy act so that startups don't have to spend hundreds of thousands of dollars just to get legal opinions or to try and get no action letters or, everything that's been going on for years. And while I just came from Miami and the Bitcoin conference and, Chris Giancarlo, who used to run the CFTC, was booed on stage when he mentioned regulation. I mean, that's not the answer. It's like that's a pretty immature response. And that, I think, is a PR disaster for Bitcoin. It gives a lot of their kind of enthusiasts a bad name, because regulation in and of itself is not a bad thing. You want some clarity, right? You want to know where to be spending your money. It's scarce. And so, while having like every single law firm jump into the space saying that they're an expert in this area, well, there's a reason that happened as well. So I don't have to tell you, Susan, as a lawyer. So yeah, I think, look, to what Noah's saying, financial inclusion is a huge use case around the world. And not enough people are working on that. There's a lot of talk, of course, that crypto is going to lead to that. DeFi will lead to that. But right now, given, expensive gas fees or whatever the case, it hasn't happened yet. That there's a very small group of people, even though total value locked is like 60 billion now, it's still relatively small in the scope of institutional capital. And I think that we're going to have to work with regulation to get clarity in order to make the institutions feel more comfortable to participate, because once that one fund you invested in goes under, then, what next? Once a pension fund, how does it justify to its investment committee that, you made this bad investment? That's just not where we want to be. So there's a lot of work that needs to be done to fix that.
Okay, great. Can you define gas fees and total value locked?
Sure. So gas fees are basically, you start out, let's say it's MakerDAO, or you're using DAI or a stable coin to enter into your DeFi transaction, probably like lending on Aave or Compound. And you need to pay the toll, so to speak, in a very simple way. That's called gas fees. Total value locked would be the amount of capital that's circulating through the decentralized finance system. It's not a completely accurate measurement, but it's what the industry has backstopped to and what they're using to measure.
Great. Okay, so Arun, I want to ask you, so what kinds of advice are you going to give to anybody who wants to invest in this? Then Tone, I'll come to you, and then I have a specific question that came up, Noah, for you. We have about 12 minutes left on the panel.
Yeah. Okay. So I can hear the music being cued, so I'll be quick. So I think a lot of things that Nisa said resonated in more ways than one. I was in Miami as well, meeting a number of people, partners, collaborators, and this whole sort of narrative around clean mining, and so on and so forth. But when it comes back to institution, I want to stress on two things. What we're finding is financial institutions not taking large positions for a reason. Regulatory risk, but also the technology is not mature enough. But it's maturing faster than they anticipated. So two things that institutions are looking for is, should they get into the custody business, right? And if they were to offer the custody business, it's no different than what they do in traditional custody, right? Traditional custody of different assets. And it just has to get the institution to think that this is a new asset class. And the moment we see that light bulb go off, then they're all in, right? Either with a sub-custodian, like somebody that builds the custody technology for them, or themselves, that they just bring it all in. Why? Because you can now offer structured products, right? We're seeing an explosion of OTC products, ETF products, traditional finance products that are now enabled by crypto, right? And this ecosystem. And that again goes back to my initial point I said about access. Now, in the emerging economies and the rest of the world, it's still maturing, but we're seeing, things in Canada and Europe and Malta, and from our lens, we're seeing all these pockets of great activity around structured product that is giving institutions some time to understand this space, while also generating some revenue when the CFO says no. To your point, you're showing some reasonable, low risk, low threshold barrier to entry kind of way to generate revenue, while also not taking on the whole risk of creating a new crypto desk, if that makes sense. But institutions aside, my last point I will make is the economic freedom. And I will say this, I go back to Noah's point, Nisa's point, we talk about inclusion, but even my 13-year-old understands what Litecoin is. Okay, and not because it's my 13-year-old, that generation, the millennial to, and this is very important for all of us to understand, that generation of the millennial to Gen Z population, their definition of value system, their definition of e-money, lending, borrowing, and exchange is very different than what we think. And once that the adoption curve is going to pull all of this. That's why we say this is so early. That's why I keep coming back. I'll give back time to the panelists.
Okay.
Susan.
Yep, very good. Okay, Tone.
All right. Yeah, I was like making notes so I don't forget. So real quick, I'm not going to get into the details, but I don't believe in decentralized exchanges really, because I don't believe they're decentralized, and Uniswap included. It's only decentralized because no one has read the code properly yet, and it probably will not last. And someone is behind Uniswap, and when that someone either decides to move on to another project or the regulators get him, I believe that project will fall apart like everything else. And that's why the only investment I recommend in the space is Bitcoin. That's always been the only investment in the space I recommend. Yes, all of the easy money in Bitcoin has been made. It's not going to go up as fast, but it's also not going to go down as fast. And going back to what Nisa said, when you said that it reflects bad on Bitcoin when people booed the regulator, here's the thing: Bitcoin is truly decentralized, so it doesn't care. Like Bitcoin is like air. It's like, oh, this is bad for air. Well, air doesn't care. So the Bitcoin ecosystem is its own decentralized engine, and what people do or say around Bitcoin is outside of anybody's control. So we just have to live with it and accept it. And this is what makes it so special and decentralized. And I have a question for Noah myself, but I'm actually going to read the question that was posted because I want to answer it real quick. And the question is, how is crypto an improvement on existing mobile money in Africa, given its extreme volatility? Prices can fall 10, 20, 30% in a day. They can also rise 10, 20, 30% in a day. So it's not just the fall that's the problem. How is this a good store of value if people need to access savings on a regular basis? The answer to your question is in the question. If you need to access your savings on a regular basis, it is not savings. The whole point of savings is to put something aside for the long term. If you need to access it on a regular basis, Bitcoin is not for you. Nothing is for you that can fall even 3% in value. You are better off storing it in the US dollar or in your local currency, but chances are the US dollar is more stable. I believe if Bitcoin didn't exist, the best long-term store of value is actually the stock market. The S&P 500 is an incredible store of value, and it has been for over 100 years, because bad companies leave and new companies go in, and S&P 500 already has Bitcoin in it. MicroStrategies and Tesla both hold Bitcoin, both in the S&P 500. So you have exposure to Bitcoin there as well. So you really have to consider that if you're putting money for the long term. But the one question I have for Noah is, what blockchain are you using for people's identity? And as a comment, the only reason why you may, I'm not even sure a blockchain is needed to solve the problem. It's just the latest technology. But the problem goes back to KYC AML. Why is KYC AML needed to get a SIM card? That is the problem. The problem is the mandated law of KYC AML to speak on a phone. That's the problem that really needs to be solved, not complications in blockchains that are energy intensive to comply with completely insane regulations.
Not to put you on the spot, Noah, but the question, if you would like to take a shot at answering, how is crypto an improvement on existing mobile money in Africa, given its extreme volatility, the question that came through the chat, and how is it a good store of value? I mean, you don't need to answer it if you don't want to. We can talk about what you think might be thoughtful regulation, because we know that your view is that it is good for your country to be using this. But if I'm curious to know your answer, if you would like to comment.
So first of all, I love Tone's answer. He's all stirring things up and making sense as well. But some things I don't agree. But yeah, I'm sure he's a good student of Safedin Ammous and his book. I've read it and I love it as well. But we'll get into that later. I'll answer this from a different perspective, from a technological perspective. Mobile money is in between two worlds. It's in between the traditional finance that has failed to meet the requirements or the needs of the unbanked, and so they don't use the banks. And then it's also in between. On the other side, it's from a telecom. It's a product of the telecom industry, and that one has figured out a way to getting to half the population of Uganda and using their service, and so spinning off a financial service, and that was pretty easy. But it was not designed to meet the needs. It's the best thing they had between a rock and a hard place. They had mobile money, because mobile money fees on peer-to-peer transactions can be as high as 10%. That is ridiculous in any standard, but that's what we have, and it's efficient. It's not efficient, but it works. And so people are not going to go to traditional banks because one, the interest rates you get on your savings on a traditional bank is minuscule, and so people just don't save. We're trying to tell Ugandans and Africans to learn how to save, and so that's where the problem of trying to access your savings in the short term comes in. But again, where I see how we are seeing crypto playing a role is as rails, not necessarily holding on to value in terms of crypto, but just using the blockchain as rails. We have a payment platform that's attached to that's linked to our exchange, where we're using crypto as rails. People can. We had a project where we facilitated donations on crypto to receive people who lost their homes through a landslide, and it is all traceable on the blockchain, and people were able to contribute crypto and they received Uganda shillings, and they were able to buy monthly rations as they were being relocated to safer places. And so we have seen, and stablecoins lend themselves really well for this use case. So it allows you to have near zero peer-to-peer fees, but then also you attract better interest rates than what the bank can give you, and you can borrow at significantly better interest rates than the banks can give you, and something that the telecom companies are not designed to do. And so that's the unique position in between that I feel a blockchain or crypto product can serve the needs there. And yeah, because people borrow money. We borrow money at 25% APY, which is ridiculous. And yet in the crypto space, if you just give people access to the interest rates they can find in crypto space, even on stable coins, and just US dollars, that's significantly lower than what's in the market right now. So again, back to my original points about how we serve the need. And to speak to Tone's question on what blockchain we're using, we use a custom blockchain, proof of stake. And again, we are serving a regulation that's there. We found it there. We had to KYC, it's in law. Whether we agree with it or not, that's the laws that are there. But then also, things like people using phones to trigger bombs that kill people. You need to know where that phone was, and you need to know who had that phone. So I'm sure they're looking at it from that perspective. Remember, I also wear a cybersecurity hat. And so attribution is one of the hallmarks of cybersecurity. If you can't attribute an attack to someone, then we have a problem. So how they're going about that attribution may be from a different or wrong way, but that's what we have. And people still need to transact. People still need to move money. And so we're doing the best with what is available, but looking at also the opportunities that new technologies bring to the table.
Great. Okay, so we are going to wrap up because the next session needs to start. Everybody is available on LinkedIn, or I believe that you can email this conference and get in touch with anybody here. And thank you very much for giving us the opportunity to have this conversation.